All right, ladies and gentlemen, I hope you guys are having a wonderful day and a wonderful weekend. We had an awesome week in trading. We're going to cover all of everything that happened. I'm going to switch to the screen here in a little bit, but in the name of all of these new strategies, from the options, the butterflies, the spreads, and all of you guys are learning so many things, I want to dive deeper into another topic, and that is dividend investing. This is important because I do this in my long-term portfolio, but at the end of the day, I want you guys to see how creative you could get within investing, and the fact that you have options, it is in your control. And I'm not talking stock options, but the fact that you could get as creative as you want to invest your money, and you could do so both safely and to your schedule. So if you've been trading options, you've been day trading, and this is why I always tell people, get some diversification. So I want to talk about dividends. I'm going to go over some stuff. We're even going to explain, some of the technical aspects to dividends. I'm going to go over some of the best dividend stocks that I like in 2019. But then I also want to talk about the risks of investing with dividends. I've seen some videos on YouTube, and it's very easy for people to like this idea of dividend investing. And honestly, it is great, but there is a downside and a risk. And this is how I think a lot of Robinhood investors are getting fooled when it comes to dividends. There is something called a yield trap. So we're going to discuss that. And honestly, this could even lead us to a little mini lesson here on bonds. So if you've seen some of the macro videos and all this stuff we use for analysis, this could give you some more insight into that. But at the end of the day, with any of these strategies I've been showing you guys, there's a simple aspect to it. And, however deep you want to go into it will determine what you could pull out of it. And I encourage you guys to really think about this. And this will give you guys something to research. And even if you're not interested in investing them, you could understand how the market views these types of plays, and how this could lead to rotational elements, and why people invest in these stuff, and so on and so forth. So before I get into that, though, you guys know what you got to do. If you would like to see more videos from me, we've been saying this, make sure you drop a like on the video, and it supports the channel. But best of all, if you really want to learn, we got an amazing community. Shout out the chat. But we are live every day, Monday through Friday, 30 minutes before open, youtube.com/the stock market. And you could see me trade this account. I have a smaller Robinhood account that we're doing. We have another 30,000 trading on premium and practicing with that. And then we have the other accounts. We had a YOLO account, and that one, blew up, came back a little bit. Stay tuned for more. But this account, this is a little different than what you guys have seen. And I just did this. I used this account. We gave it to some people at the office. I wanted to, make some tests with the stream alerts and see how it was working. If we literally gave it to random people or people with a remote interest in investing, I wanted to just see how they would use it. But we've been discussing strategies to do. And I'm seeing what people are talking about. I see all of you guys, and I'm just getting excited sharing all these strategies, whether it be the butterfly spreads, all that. But I'm thinking of turning this into a dividend portfolio. But my theory I want to do is mix in options, because now you'll see the aspect of getting fixed income or getting a yield off of the dividends. But now if you could implement even dividends and selling calls or covered calls with stock, that's where we could get into a whole different realm, and it could add the yield. But as always with these strategies, if you give something, you get something. So there is a sacrifice. So let's jump to the E-Trade so we could scan through this. And so you guys will see this account here. And if you like the Robinhood videos, let me know, because last time I made some of these videos, I've been a little hesitant. Some people, they like them, they don't like them. But I think, regardless, I want to make it just to educate some people, because I think a lot of people are starting into Robinhood, and Robinhood is even pushing this dividend stuff. And honestly, dividend investing is a 10, 15-year strategy. It is amazing. And that may sound like a crazy long time, but it's really not. Trust me, man. I'm old now, and I thought I was young a few years ago. But in all seriousness, it's a very great strategy. However, at the same time, I want you guys to understand the deeper aspect. Even Robinhood will say, do you think the stock is going up or down? Buy a call, buy a put, dividend, and this. So it's free money. But I want you guys to understand the difference. All right, so let's just get into it. I want to discuss a few things related to the dividends, in the sense of why would you want to invest in them. I think that's a great place to start, because this is a good area to turn a decent amount of money into a large amount in the long term. Keyword is long term, but you could take a slightly large amount that you're having sitting. This beats any savings account or anything like that. And again, even if you're waiting for options plays or anything like that, where to put, you could let your money sit in places, and we're going to talk about where to let it sit. And that's why this whole concept of a yield trap is very important, so where to put your money safely, and safety and yields. If you've heard me talk a lot about this stuff, it makes a lot of sense when it comes to dividends. But the key to dividend stocks and dividend investing has nothing to do that, the yields are great, but it's the power of compounding. So you guys have heard Warren Buffett talk about that. It has nothing to do with what you're making, in the first month, the year. It's cool to make, I'm going to make $700 a month, $200 a month, whatever it may be. But at the end of the day, it is after the first year or even the second year, you are now reinvesting that. So you earn the dividend, and now you made money on your original investment, but then you reinvest that. And now you're making money on the original investment in the gains. So as you compound that year after year after year, that's why at 10, 15 years, it really starts to get crazy. But now the best part about it is the stock can appreciate too. And that's what I'm going to show you guys with some of the stocks that I hold in my long-term portfolio, but also some stocks that are just really great for dividends, and some that are kind of intimidating, and understanding the reasoning why will let you know a lot more about the stock market in general. But now, one of the big things I am going to focus on here is a concept called beta. So this is a different type of Greek, it's not the Vega and that, and you guys know how I feel about all that. But what this is telling you, it's a measure of the stock price volatility relative to the overall market. So this is I'm gonna show you one of the companies I really like, and I actually hold these. This is some Michael Burry stuff right here. AWK, American Water, and I got this around 2016, 17, I believe. I got to get appreciation, and it offers a very great value. But again, now, dividend stocks, each possesses its own, and we'll talk about what makes a quality one and what you should be looking for, because the beta is a big factor. But now also, if you're making too much money or the stock's too volatile, you don't really want that, So even though this looks like, whoa, I made a big gain over the last 4 years on it, but the problem is that's a big move. But what I like about this stock, it has to do with the beta. So I believe the beta on AWK is around 0.23, which means it's about 23% as volatile as the overall stock market over the last 3 years. So that should let you know what's important, because a dividend, you are putting your money, you're buying 100 shares, and they're paying you a dividend per share that you own. And we're going to talk about the dividend yield and the dividend itself, but think about the aspect. You're investing in the company. By you holding their shares, you're giving them money, or technically you're holding up the share price. You're not really giving the company money, but the company is to return profit back to the shareholders. So a dividend is a form of that. It's one of the best ways to receive a profit in a stock. You also see profits used for buybacks, expansion, whatever, but not all stocks have dividends, and not all stocks have high dividends. But again, the high dividend means stuff, but the whole point is you have to be holding the stock to collect the dividend. So a lot of people ask, can you just buy a stock and collect the dividend? Yes, there's called an ex-dividend date. So there's pretty much a deadline to where you have to be a shareholder of record to receive the dividend. So if you want to go after that strategy, some people just like to go play the dividend, hold it in between that period. This is why I'm bringing up beta. You want to play the low beta stocks. You want stocks that are not as volatile as the market, so you could park your money in it and it doesn't go down, because this is what I'm going to talk about here towards the end of a dividend trap, and where Robinhood kind of gets it wrong here. Or not even, I wouldn't even say they get it wrong, but what a lot of new dividend investors ignore is that, sure, it could have a good yield, but again, like with this AWK, even though I love this stock, the good thing, it has a low beta, but the last thing you want to do is put your money in, hold it, and yeah, you may be getting paid out monthly, but if the underlying value is dropping, it's not too good. Think about a real estate property or a rental property. It might be good if you're getting, double the rent or triple the rent or even any rent at all, but if the property is losing value, that's, at the end of the day, are you getting a net positive or gain? And that is the issue with dividends. And again, it's slow and steady. It takes a long time to see a worthy return, but some of you would be surprised, because again, that beta of a few percent is better than losing an account or blowing it up, trying to trade it and actively manage it. So the best part, having this low beta, it hasn't been as volatile as the market, and you could probably see that visually since 2015. It did its thing. Even when the market dropped, it didn't really drop, and this is what you want from it, because I parked my money in there. It did have some of these hiccups. I park my money in there, I collect my dividend, and it's awesome. Low volatility relative to the market, and it pays a decent dividend. So now let's take a look. What is the dividend and how do we calculate it? So it does get a little bit confusing depending on where you're reading it from, because like E-Trade, I noticed they put the dividend here. It says dividend 50, and that is correct, but they're telling you every quarter. Some places, when they list the dividend, they should be listing the annual dividend. So even though this dividend is 50 cents, if that's every quarter times it by 4, that's a $2 dividend. So then you go see the dividend yield is saying, the dividend yield percentage is saying 1.69. So take that $2, that annual dividend, divided by the stock price, 119 flat, you're going to get 0.1689, and there you go. It's the same dividend yield. So here is the formula. It's easy to get confused on this. You know, it's a simple but confusing concept. But the dividend yield percentage is simply the annual dividend divided by the price per share, as you just saw me do. So you will be getting 50 cents per share every 3 months, which adds up to $2 every year. So what it's saying with this dividend yield percent, so if you see a stock at 1.69, that means every single year, not every single quarter, you are going to receive 1.69%. So this is what I focus on when I'm doing my dividend, plays. Sure, a high dividend on the quarter could be good, but what you're really looking for is the yield. How much money are you getting returned guaranteed on your money? And again, what is going to be the beta or your risk of losing value on the stock? So you're going to get 1.69% a year just by holding it, and that's easy to calculate. You don't need to calculate how many shares, yada, yada, yada. It's very simple math, and when I go to set, this is what I'm going to do with that Robinhood account. When I'm going to set it up, you could just pick the amount. You put $1,000 in. It doesn't, you're like, how many shares is that? I don't really care, because it's just the carrying amount of $1,000 times that by 0.0169, and you're going to get $16.9 a year. But again, the whole point is the next year now, you now have 1,000 the next year. Now it's 1.16. Again, times that by 0.0169. Hey, now we're getting $17. So now add that to the 1,016. You're at 1,033, and that's after your second year. But that doesn't sound appealing, but take a look now. Look at AWK. If you pick the right dividend stocks, not only are you making that compounded money interest, but in the last 12 months, you would have actually made 41%. So not only would you have made that extra money, but the share value would have went up considerably. You would have made 41% on the equity. You would have got that dividend. And now here's another part that people miss. Oftentimes, if it's a solid company, it's doing good, they actually have a trajectory of raising the dividend. So you could actually be receiving more and more and more. And this is why if it splits and then you get more shares, now you're getting more dividend per share, so on and so forth. But again, the sweet spot is getting a good yielding dividend with a stock that's not only going to go up a lot, sure, that's great, but will actually maintain the value. And now this is how you get into this game of observing, what is a good company, what is a bad company. The problem that people have and what makes them select really bad companies is they want a high dividend, and they're ignoring things like the beta, the volatility. They're forgetting you got to hold the stock, and the plan should be over a longer period of time. But it's just like bond rates. It's just like a credit card. If the yield is high, that means a lot of risk. If a guy came up to you and said, hey, man, loan me some money, I'll give you 19%, 20% interest on it every month, you're probably not going to be like, oh, man, that's a sweet deal. I'll throw this guy in my Robinhood account, and, oh, this will pay for my car, my this. You're going to be like, why are you offering me such a high amount to give you, any sort of money? That seems a little sketchy, because it is. Remember, if the stock like I said in the beginning, you're not buying the stock from the company at this level unless it's an IPO. So imagine this. If they're offering a high dividend, they want demand on their stock and people to buy and hold, and an incentive to hold the stock and keep the supply constricted so that it could keep their stock price up, so that if they do need to issue more shares or whatever, their compensation, it allows them to do good. So by offering you a high yield, it's kind of like they're asking for credit. They want you to put in their money, and they're offering a good incentive. So AWK, this is 1.69% a year. You could get a higher return on a government bond. So why wouldn't you go to the government bond? Because, well, government bond's not going to go up 41% on the underlying. You're getting a lot more opportunity here, but there's safety. You know, AWK at 1.69, this is telling you, hey, man, we make a lot of money. We'll give you a profit. We want to reward our shareholders, but we don't really need them that bad. And I don't know if you could say that bad to an extent, but that is the whole point. So this is what I want to talk about here now with dividend traps. If you are selecting and creating a portfolio, you have to be careful of the dividend yield, because if it is too high, although it may be attractive, you might be in a stock where they're trying to get the dividend really high up there to encourage or entice you to buy and hold the stock, which means it might have a high beta and it could be, you know, susceptible to bigger equity loss. So even if you're getting 10, 20%, which are extremely high, if the equity is going to be that much more volatile, is it really that good? Or are you actually really making a net positive? So let me use this as an opportunity to bash a REIT, because honestly, I hate REITs. So REITs are actually good income producing stocks. That's why they actually did it. REITs give you an opportunity to invest in real estate without having to pay taxes, deal with tenants, or so on and so forth. But you guys know me in real estate. You know, I got it in the bag. We got a whole team. Man, we nationwide, baby. So we got that under control, but I'm not a big fan, but let me use this as a great opportunity to bash one. But no, and honestly, it's a clear sign, because this would trick a lot of people, where Washington Prime Group, WPG, this is a mall REIT. So what they do is they own a bunch of malls, so people invested into them. They take all their money and they use that money to buy up commercial property and rent out the malls. And what do? They take the income from all these malls, and then they, you know, they also use your money to cover all the expenses, and then they pay you guys out a dividend. REITs are notorious for having good dividends, and one of them I like, but I'm not invested in it, and a lot of people know about it. O is a great one, and you could see here the yearly dividend is 3.7%. And again, let me tell you guys about bonds, and kind of going back to anything in the world of bonds, anything above 5, or aka 6% or higher, or anything above 5%, is a junk bond. It's considered high risk. So 5, 6, 7%, you're getting into high risk area, because if it's supposedly safe, why would anybody be offering such a large return, considering the bench standard we have for government bonds in the United States, and that's the safest, easiest return you could get. So anything, you know, kind of anything above like 2.5 to like 4 or 5, as you approach 5, it gets a little high, but those are you know, above average yielding bonds, or, you know, kind of in the middle. And then anything 1% or lower, that's a low yield, but the yield of the bond is showing you the safety. So at 3.75, you're kind of getting the idea, okay, O is pretty good, but, you know, that yield is pretty high. It's definitely not AWK, but you'll see. So going back to WPG, you know, this is a mall REIT. So we see what's happening. You know, Shields is a bankrupt, is literally a Q company right now. Sears, JCPenney, Macy's, these stocks aren't doing too hot. And these guys are the ones who own the malls where these companies rent, and they start to close their stores, so on and so forth. So take a look. This is perfect to trick any Robinhood investor. Why? It's $4. You're like, dude, I'm going to get so many shares of this at $4, dude. Oh my gosh, I can't wait. And like, guess what, dude? It pays 25% dividend yield. Oh my gosh. So that's every year. That is actually insane. So think about it. You're getting 25 cents a quarter. You're getting $1 a year. $1 a year divided by $4 is 25%. You're making 25% on your money guaranteed every year by holding the stock. But okay, so do that for a year. You're going to get 25% on the dividend yield, but the 12 months performance is down 50%. So you're going to take a net loss of 25% on the year. Now, the whole point of a dividend stock is that if you collect this over the years, so imagine these guys over the years collecting that, even if you hold through the pain, you might have bought at a higher price, or if you somehow buy it at a lower price and you're able to hold through, the whole point is it should offset, because now if you're making 25% of your money, let's say you put in $1,000, every year you're going to make 25%. After 4 years, you will recoup your initial investment. So the point is, if you believe that this stock will be sustainable and at least won't go down from here, and that's why, think about it, the beta is calculated over the first 3 years. You take that 4 years, you've already made all of your money back. So if it does bounce from there, even if it holds the same price, imagine now it just stays at $4 flat for the next 4 or 5 years. You would actually be making money off the dividend and collecting more and more and more, but that's assuming the dividend stays the same and they don't do worse or cut the dividend, so on and so forth, and those are your risks. But this is where I'm saying, that's a high yielding stock. It's not too good. The point of what you need to be doing is finding high quality stocks that you could hold and kind of give you a mix of high yield and the safe yield. So now that we've kind of got that out the way, I just want to make sure you are aware of that. And let me know if you guys want to see me build a dividend portfolio. We have that account. Tell me what you guys want to learn, because I love blowing people's minds when they learn this stuff. And at the end of the day, it's making you guys smarter. You're going to be able to contribute more and understand this stuff. But really what I want you to truly understand is you guys are in control. This is why Warren Buffett, Benjamin Graham say you need a sound framework of emotional intelligence and an intellect to make investments, because all it is you deciding, I want a lot of money, I want it now, this and that. But you have to be able to find that balance. And once you realize you are in control, the stock market is not as scary as you think. And when you see, imagine like AWK, when I'm telling you guys that, think about it. I sit at home every day, 7 hours a day, and I live stream on YouTube for free for people. Shout out AWK. This thing is, year over year. I'm entering now my third or fourth year on this, while taking roughly almost like a 300% gain, or even 100% gain almost on the initial investment. That thing, and it's paying me income. Now you add that to real estate. This is what you want, but that's relatively a short time. I think a lot of you, 2016, some of you have been following me since then. Totally weird flex, but I'm trying to inspire you and show you guys the opportunity here of using your time in the market, and you're in control. It's not that people, a lot of times it's really easy to simplify every sort of investment. Oh, it's too risky, it's too slow, it's too this, it's too that. But you could get into some dividend stocks, and find these crazy balances. And then you mix knowledge of timing and you're using this econ stuff. Yeah, sure, this is 1.6% to the guy who isn't, managing his own stuff and is not really applying himself or letting someone else do it. But you could really make some tweaks and now use some of that risky degenerateness you guys have and tweak it to get you in a win-win situation, but also utilize time, especially if you're young. If you're watching this video and you are below the age of 25 and you're not stacking away literally just even a couple $100, start building up a portfolio like this, you're wasting your time, because you will blow that money, paper trade and learn how to day trade with paper money. Go get some dividend stocks and long-term stocks and hold them, because again, even if they drop over time, they're still going to be paying you a dividend. And imagine that's how you make the money back over 10 years. And that's why people are in the stock market. And that's what these companies want. They want people to hold their stocks. And that is the point. But the possibilities are endless, and you guys are in control. So that being said, now let's go over some of the stocks that I like for 2019 as far as dividends. AWK is one of them. You guys could look at, and even then, here's Barnes & Noble's. This is one of those unique ones, actually, before we get into those, because you guys saw that play. We played it on the buyout. It got bought out and did good, but they have a huge dividend yield. That's AWK. You see here, it's about 5.78. And again, it's a lot higher simply because the stock price jumped. So think about that. You remember the formula is annual dividend divided by the price of the stock. So the stock price jumped up, but imagine a week ago, the stock price was at $4.59. So if you're getting 15 cents per quarter, that's 60 cents a year divided by what? 430, let's say. You're walking away with a 14% dividend. So now the dividend doesn't look as bad. And now think about that. That was probably in the formula when they decided to buy it. They're like, okay, they got it's just above high risk, just below junk. But think about it. Why was Barnes & Noble's at 14% yield? Literally, Barnes & Noble had to pay people to invest in a bookstore. It's 2019. Look at Shopify, Amazon, all that. It was paying a high yield to offer a high incentive to people to invest in the stock and keep holding it. But now this is, you see in events where it gets bought out, or like we're saying, some of these high yielding stocks, if they change course, because what makes the yield high is if they're already paying a dividend that's high and then the stock price drops, allowing you to get more shares, that yield is going to shoot up. That's why when the stock shoots up, the yield comes down. But take a look here. You could even see the performance in the last month was 41%, 15% in the last 6 months, and then 3% in the last 12 months. So again, the fact that you got a gain, this looks like a normal stock, right? Being up 3% in a year with a 5.78% dividend yield, this actually looks really solid. You're like, wow, it's only moved 3%, so the beta is probably in tune with the stock market. It's paying a decent dividend, slightly high, but you're like, but then you understand the business model here. But essentially, before it was up 3%, literally subtract what? $2.40. You know, bring this down by 30%. It was probably down 40% on the year, or 30% in the last 12 months, and that yield would have been a lot different. It would have been much higher, but you would have lost your equity to receive, you know, that 13, 14%. Like we said, if the stock is down 40% on the year and you yield 14%, 15%, you still lost 35% of your net money. But again, this is why people would hold, though, because take this on the longer term now. This is the whole concept, what I'm saying with the dividend. Imagine you were buying it here, and we could see what their dividend was at. They were probably raised it as the stock was dropping. But if you held it for, again, 3-4 years, even if, you know, imagine you bought it at this low price, even at $7 at one point, it could have went up. But the whole point is you're collecting dividend year after year after year after year. And then finally it does get bought out. It comes up. You know, if you're based on your share price, you had to really, really hit this sweet spot. So the guys who bought here in 2017, they got to collect, what, about 3 years of dividends, and the equity is the same. So pretty much they held the stock. The house price stayed the same, and they got 3 years of free income. Or the guys over here, but maybe if we go back in time and could see if it was any lower than that on the 20-year. Now, the guys, imagine these guys holding since 09, or, you know, just above here in 2003 or even 2000. And that's when Barnes & Noble was hot, man. But that should give you guys a good one. But Barnes & Nobles is not one of the top ones I want to look at. I like AWK. I think that's one of my favorite ones. I love investing in water. And again, that yield. Another one is Nextera Energy. So you could take a look, NEE. This one's good. And again, I'm like to show one for the younger guys. You know, if you want to get more aggressive, you want to try to find these solid companies, again, low beta, that are still moving and they're getting big equity gains year over year, but then they're also paying a good percentage. So 2.4 is a little high compared to the water, which was at like, what, 1.6. But think about it, it's energy. And now with these dividends, the companies that are paying the best, because the next one, again, real estate, that makes sense why there's a high dividend. Water, you know, think about it, a commodity. Everybody needs water. Everybody needs a place to live. Energy, everybody needs energy and fuel sources. And then the next one, let's just get what everybody needs. This is one of my favorite, another one in my long-term portfolio. I do not hold NEE, but J&J. You guys have heard me talk about it. Now this one has a 2.67. It's kind of like energy, and it kind of with everything, but you take the year over year, it's up 14, but considerably, they still went up about 15%, almost 50% since 2016. Johnson & Johnson gets you a little bit less of the gain, but still pretty aggressive. It's just a really solid company. A lot of people do it, and it covers, you know, all of the items that, you know, year after year after year. These businesses aren't, you know, driven by seasonality, technology, or anything like that. So another one is Blackrock, but this one's a little bit more risky. It's a lower share price. The dividend's 11%. The fact that it has only moved, you know, down 3% in the last 3 months, it's done good. But now this is financial. But if I were you, I would look, you know, I would go for a safer one, a safer financial stock. Because again, we just said energy, the basic goods, water, real estate, now finance, you know, banking, money, and all that. But BlackRock is good. And again, the fact that if you could get 11, 12% while the stock is only dropping 3%, you could get a net positive on there. But it is kind of held up. But the thing about this, over the last, you know, 4 or 5 years, the equity has dropped compared to the overall market. And BlackRock, they are very, very, you know, they could cut their dividends at any moment, and they have done so a lot in the history. And that's one thing you got to realize. Any of these percentages can change at any moment. But BlackRock, it's, you know, I like it because if something does do good with them, these are the ones you want. Again, if you want to do, you could do so many risky strategies. And this is what I'm trying to show you guys. You could be really, really safe, or you could be really risky. The world is yours, but understand the concepts behind it. But even then, not only have they cut dividends, this is a little bit more of a riskier company. They hold a lot of, you know, think about the nature of finance. They're giving out unsecured debt, all sorts of debt, loans. So if any of those default, that could lead to a problem. Another good one that a lot of people bring up, Ford and GM. I prefer GM a little bit better, but people like the 6%. And this is what I would say with these, kind of considering the headwinds. I prefer GM over Ford. And you go, they're both about 6%. Or I think GM's around 3%. Yeah, 4% now. But these, you know, considering the headwinds they have, most of the time they're pretty stable. They could come down here a little bit. Even, you know, Ford is already came down here a little bit. And again, even though you're getting 4%, you're losing 11%, or that's GM. Ford's probably a little bit worse. You're getting 6 at 14. They pretty much average out. Makes sense. it's an auto company. Again, a lot of people and everybody's kind of always buying cars. You see how much it's dropped over the years. You see where it's at now, but these are the ones I want to wait till if the price comes down. And I don't like really Ford for the appreciation and the large float, but GM I do like, because I think if this does come down around these levels, it did in 2015, you know, it drops a few more bucks. It's all, you know, they have a good history of paying the dividend and keeping it relatively high. That's the thing about the automakers. Even though they might not go up a lot, their history with dividends is very, very good. So if it does drop below this, you know, I would want to get one of these slower movers that aren't really too appealing now. You set up a strategy to buy them here at the bottom. But that's the same concept here with the last one. I'll leave it on Apple. One of the most solid ones. It's all about the price you get it at. That's why Apple is such a tremendous stock. And, you know, think about it. They actually announced they're going to raise their dividend. So if you're able to get it, that's the whole point. You secure it at a low price. You're able to get very, very good equity and a very good dividend. And it could do a lot of stuff. You know, imagine if you bought it 6 months ago and you were getting the yield, you would have been returning, you know, again, this is the annual yield. So cut that number in half. You would have got what? 26% plus an extra almost point or half a point on top of that. Not too bad to hold the stock and get the equity gain. So I'll leave it there. But now I tell you guys to post your watch list. So please post your favorite dividend stocks below. But I'm going to leave it there. Let me know what you guys think about this. I know it's long, but I think it was kind of straight to the point because we were talking specifically about these goes to the companies. If you like this stuff, please let me know. But hopefully you did learn something new. I love you guys. Drop your like. Show some love. Make sure you're subscribed. And I'll see you tomorrow and on stream. YouTube.com/thestockmarket. Let's go.